What's up, guys? Today we're talking about the 5 key roles that taxes play in your home buying journey. I'm Victoria Santos, your DMV home matchmaker.
I'm Edwin Velasco, your local mortgage expert.
And we're going to jump right into it because tax time is coming up and we want to make sure that you get these done correctly. So the first topic is going to be how your income on your tax returns impacts your loan approval. So basically, to break it down, if you don't report all of your income on your taxes, and there's no proof, we cannot use that income. Is that right, Edwin?
That's correct, yeah, especially if you're self-employed. So with self-employed borrowers, we qualify you based on the net income that's being reported on those taxes. So a lot of times people will call me and say, hey, I make $100,000, right? But most times what they mean is they make gross $100,000, not net. So I always have to confirm or ask, right, what is your net income? Because on the loan side of things, that's what we focus on. We're going to be focusing on what is the net income that you are actually telling the IRS that you earned for that year.
And this is why it's also important to have a paper trail, right? I think a lot of the times we get people who are either self-employed or want to leave their income in the mattress or get paid cash and then don't declare the entire amount at the end of the year. And that's only going to hurt you as a consumer, as a buyer. When you want to do anything that you need credit or, again, to be able to prove that you make that much money. So if you've been, let's say, getting paid in cash and not declaring it all, you're supposed to, number one. And number two, we cannot use any income that does not state on the documents. So that's a big thing that if you're thinking about, okay, the year 2026, I want to buy a house, then it's very important for them to not write everything off if you're an entrepreneur, and declare everything that you make, because we want to be able to use as much as your income as possible. And the only way to do that is if you declare it all.
Yeah, I mean, there are other loan programs that will still work with you, even if, let's say, you maybe don't report everything. But the one thing you have to keep in mind is most of these programs are going to require a much higher down payment. Mm-hmm. So if you can meet the higher down payment requirements, then maybe we can still make it work, right? But a good rule of thumb is you want to try to make sure you're showing as much net income as possible if you want to do like low down payment type of programs or things like down payment assistance, because those types of programs require us to show the actual tax returns.
Right. And I think that's also the key important part to note, because there are type of loans where you can use like bank statement loans, right? You don't, in a sense, have to prove this steady income. However, the little offside to that is that you have to have the cash. You have to have $50,000, $70,000, $100,000 to show that you have the money to be able to purchase. So definitely being able to declare as much as you can, not write off everything that isn't a write-off. You went to the store and you bought something for your kid. It's not a write-off. But just being more, intentional about tracking what your actual expenses are, and also just writing off what needs to be written off, and the rest, we're not writing off just everything. So that's the first one. The second one, you want to say it?
Yes, second one is going to be using your tax refund for your down payment or closing costs. Mm-hmm. So a lot of times folks will say, well, I'm tight on cash, right? Mm-hmm. And while we can get you down payment assistance doesn't always cover everything. Mm-hmm. So this time around, this time around the year is when we really have to pay attention to those tax refunds, because a lot of buyers are actually receiving tax refunds and using that towards their down payment or closing costs. So a lot of times when we look at bank statements, right, we tell people, don't deposit money.
Yeah.
Don't deposit cash, right? But what happens is with these specific deposits is we can track them. Mm-hmm. We can look at your tax returns. We see what the refund was, and we see what the amount that was placed in there was, and we're able to put 2 and 2 together, right? But yes, you can use that assistance, that tax refund towards your down payment and or closing costs.
Yeah, and that's like what you said is there's a paper trail. You can see, once you provide those documents, because you have to provide all pages of your tax return or your taxes, that how much you're getting back. So it's not going to be a surprise. Now, if you are expecting a tax refund, right, and you're thinking about purchasing a home and you're expecting let's say a large lump sum of cash, this is exactly when people should be saving for specific things like this, a home, because sometimes a lot of people don't encounter, just throwing numbers, $10,000 at one time.
Yeah.
And if you're getting a refund of $10,000, then you're hoping to purchase a home, that, if not all, majority should go to your account, your savings account, so that you're able to use that. Because yes, there's down payment assistance programs, and we've gone through this before as well. However, when a first-time home buyer or a home buyer has cash already in the bank, you're already being put on a different category when you're submitting offers. It's a lot easier and not as intense, because we're not going in there having to ask for $15,000 from the seller, or we're expecting $25,000 from a down payment assistant program. And not only that, but when you put in, like, let's say for your deposit, you have to have X amount of money already in cash into your account. So having some type of funds to purchase your home is extremely important when you're going to start this process. If you have zero for savings, we honestly can't even start. Yeah. Because every time you write an offer, let's say you find a property, you love it, you write the offer, you have to put in minimum 1.5% to 3% of the home as a deposit. So that right there, if you don't have it and your offer gets selected, now we're
stuck.
Yeah, we can't.
Unless a family member can give you a gift.
Exactly. Or you basically just lied on a contract, because the contract says you have to deposit this cash in X amount of days. So having money saved is very important when you're looking to purchase a home. And if you're expecting a tax refund, then this is like the perfect amount of money to be able to put aside.
Yes.
So
absolutely.
Tax refund, save it.
Yes.
Now, we talked about this already, but what to know about tax write-offs and if you're self-employed, because again, we talked about this a little bit,
yeah.
But as an entrepreneur ourselves, right, we have to write off certain things that are for our business, right? So
business expenses.
Exactly. Business expenses, where you basically are buying these items or, whatever services for your business. Now, what would you say are some things that you've seen when people do their taxes, whether they're self-employed, and then they write almost like everything off? Because we know we've seen it. Like, it's not like we've seen it where you own a cleaning business and then now you buy cleaning supplies for your house, your brother's house, everybody's house, and you're writing it all off. Like, what happens when you get something like that?
Yeah, so a lot of when we're looking at self-employed taxes, we're looking at what those deductions are. And a lot of what I see are things, for example, like uniforms, right? Mm-hmm. Like, people are getting uniforms, like, it seems like every other day sometimes, according to what they're reporting.
I don't even buy uniforms every other day.
So another thing is gas, right? Mm-hmm. So, for example, when someone has a simple business return, like a Schedule C, we can use or put back as income the miles, so business miles. Mm-hmm. But if you just claim gasoline or gas for, let's say, this 4 vehicles, but you only really use 2 or 3 of them, but you're putting everything in there. So I see that a lot as well. The other thing is meals, right? Mm-hmm. Meals and entertainment. It's actually a line item on the taxes. And a lot of meals and entertainment are not always business, mm-hmm. right? So at least once I have that one-on-one with that self-employed borrower, I get a better understanding of, okay, that wasn't 100% a business expense, but it was added. But that's a lot of what I see is people with uniforms, mm-hmm. The gas, and the meals and entertainment.
And what happens? So what happens if they're like, no, I made $75,000 this year, and then they present your taxes and it says $25,000. Like, or how do you handle that?
Sure. So we have to go based on what the guidelines are. Mm-hmm. So it's not what I can do.
It's your fault.
It's not what the bank can do.
You didn't give them the free approval.
Exactly. No, it's especially when you're self-employed. It's what's on paper.
Yeah.
And we all have to, all lenders, we have to follow the same Fannie Mae, Freddie Mac requirements if we're following that specific loan type. And they all require us to look at specific line items on that Schedule C form. So if they say, no, I make 75, well, I have to go with the guidelines that says I have to use the net income on line 31.
Yeah.
That's what I can work with.
Yes.
So I usually, if I get a lot of pushback, I have to actually pull up the guidelines and say, hey, this is what I'm required to follow.
Mm-hmm. Yeah, so don't be mad at Edwin, because we've seen it too. It's like,
Yeah.
él no me dio.
Right.
He didn't give it to me. He didn't pre-approve me for
Right.
the amount I wanted. But again, the reality is paper trail. You know, we hear a lot of cash is king, not when you want to buy a house, and unless you have a huge chunk of it.
Cash in your bank account is king.
Yes. So definitely paper trail is going to be very important for you to have that. And again, just going back to our write-offs, entrepreneurs specifically, you know, I get it. We want to bring that amount that we owe at the end of the year. We want to bring that down. I get it. And so we write off everything that we feel is a business expense. But where it gets tricky is you want to buy a house. And when you want to buy a house, if you said that you only made $25,000 that year, then unfortunately, that's what they're going to go off of. So just keep that in mind. The next one is the impact of unpaid taxes. So on your credit score or tax lien. So if someone doesn't pay their taxes, what does that look like?
Sure. So we'll receive the taxes, right? And we'll take a look at, did you receive a refund or did you owe taxes to the IRS? When I see that, that's the first question I ask, which is, hey, how did you pay for your taxes? Are you on a payment plan? Did you make a lump sum payment? Are you not paying them at all? Yeah. Right? Because there's certain requirements we have to follow. So if you made a lump sum payment, great. We just need to source it with your bank statement showing the payment coming out, and we're good to go. Mm-hmm. If you're under a payment plan, then at that point we have to receive on the lending side a copy of the actual accepted IRS payment plan. Mm. So it's not just you, hey, I submitted this paperwork and I'm on a payment plan. No, the IRS has to actually physically mail you a form that says, hey, this is the payment plan we've accepted. Starting on this date, you're going to make this much of a payment. Mm-hmm. And the one thing to keep in mind with payment plans is this is an additional expense on a monthly basis. What that means is it can impact how much you qualify for. Yeah. So if previously you were qualified for $400,000 before we review your documents, now we look at your documents and we see there's a balance there. You have a monthly payment to taxes of $250. Now it's not $400. Now it's maybe $375, maybe $370, because you have an additional expense that we have to account for. Right.
Okay. Good to know. Awesome. So the last one is tax benefits you could enjoy as a first-time home buyer. So when you do purchase a home, now you're a homeowner and you can bring that document to closing, not to closing, once you do your taxes, right? So you have that document that shows that you are now a homeowner and you bring that with you to get your taxes completed. The other one was
a 1098-R.
Okay.
Which is the mortgage interest form that you get from the loan servicer. So one thing to keep in mind, guys, is when you are making payments to a mortgage company, when you are paying an interest, a portion of that is tax deductible from your regular W-2 or even self-employment income. So this now becomes a deduction. So you have to bring that form that you get from your servicer, loan servicer, and let your tax preparer know, hey, this is how much I paid in mortgage interest, because that will help you save some money when it comes to tax time.
And when you do your taxes, like they should ask you, like, hey, did you buy a home this year? Did you purchase a home? And that should help you with like, oh, let me go, pull it up online. You can look up on your Mr. Cooper, whoever you pay your mortgage to, and the statement. You should get an annual statement for that. But yes, as doing your taxes and getting ready for your taxes is very important. So that's what we want to talk about pretty much this month of January. We want to make sure that you're prepared because tax time is February, just next month, right around the corner. So any questions that you guys have, let us know. We're happy to help in making sure that you are set to purchase your home this year. So Absolutely. If you guys have any questions, let us know.
Bye.